The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. On today's episode, we're going to be doing part 2 in our summer series on entity types, discussing sole proprietorships. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you, Chandler.
Real quick, important dates coming up. We have our extension deadlines for flow-through entities on September 15th, and for individuals and anything else that had an April deadline on October 15th. 2024. Let's get into it, Spencer.
Yeah, I'm actually pretty excited about this. When we were coming up with this script, there was a lot of things that I just kept adding more stuff to this list of stuff that I didn't think we would. You hear about partnerships and S corps and how much compliance there is, and they have their own separate tax form, and so you think, oh, Schedule C, it's pretty simple, and there's actually a lot that can go into sole proprietorships in general. So
it's amazing for any line you see on a tax return, how many lines of written text there are behind what can be entered on that line, right?
Yeah. So those who, if you're listening, you probably don't know. There's an instructions that comes with every form.
Yep.
And if you think the forms are hard to read, try reading the instructions. There's some forms have so much instructions, and sometimes they go every single line you get some instructions, and so with the Schedule C, it's no different. And when we say Schedule C, you can kind of also think of it as like a sole prop. So
yep,
sole prop is kind of more wordy. So when we say Schedule C, it's just kind of cleaner to say. It sounds better.
Yeah, sometimes in the parlance of accounting, right, we'll be like, oh, this is on your Schedule C, or a business owner might say, yeah, this is my Schedule C. Like,
yeah,
that's your sole proprietorship.
Yeah.
Somebody else, you might have an LLC or a partnership, and you say, this is my partnership or whatever. Yeah, this is my Schedule C.
Yeah, or sometimes we'll send emails and be like, oh yeah, this goes on your Schedule C.
Yep.
And that's pretty much what we're talking about. Schedule C, of course, being a form that is on your 1040. Your 1040 being your personal tax return that you file. That's due April 15th of every year. So, yeah, so Schedule C, float onto the front page of your 1040. The income is taxed at your personal level, which makes sense because it's shown on your personal return. Regardless, I think it's important to note that regardless of if the money has come out of your Schedule C bank account, you're still taxed on it. So if you make $100,000 but you haven't actually taken some of that money out, it doesn't matter. That income is still taxed in the year that you earn that income. So it doesn't matter if you've taken money out, you're still taxed on it regardless. And speaking of it being taxed, it's taxed at ordinary income rates. And for currently, the rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So it can go across a lot of different ranges, and maybe we'll have an episode later on how the tax brackets work, but that's where your Schedule C income is taxed at. And when people call about, when they say ordinary rates, those are the rates.
Those are the ordinary rates.
Yeah.
For
Currently.
Anything that we call ordinary income ends up getting taxed at those ordinary rates.
Yeah.
But
ordinary.
So the other thing, so that's not the only income tax you pay, or that's not the only tax you pay.
Yeah, correct.
From your Schedule C income, right? So by definition, if you have income on a Schedule C, it's considered self-employment income, and it's going to be taxed, be subject to self-employment tax.
Right.
So that's essentially, it's to cover. So if you are a working man and you have a job that you go to 9 to 5, and somebody else is your boss, you typically get issued a W-2 every year, right?
Yeah.
And part of that W-2, there's taxes that are taken out off of every paycheck. There's going to be Social Security and Medicare tax, right? And that gets taxed on all your income with certain limitations included. So it's the same thing that's happening on your Schedule C income subject to self-employment tax.
Mm-hmm. Yeah. It's a way for the IRS kind of to make sure that you're still paying your fair share of self-employment tax, or really Medicare and Social Security, and
Well, that's what it is. So that's what self-employment tax is. It's Social Security and Medicare tax. It's making sure everybody's paying into the system. But to be clear, like, you get a benefit when you pay into Social Security. So it's important that it gets tracked. You end up, at the end of the day, when you are ready to retire, you get, and you apply for Social Security, you get a payment that's based on I think it's at your 30 highest years of earning. Of income. I think that's what it is, and maybe we'll do a quick little research, and I can update you if I'm wrong on those dates. But so it's important that you want to pay into Social Security, right? That's a good thing to have in retirement.
Mm-hmm.
Hopefully, there's some there for us millennials at some point.
Yeah, there's a lot of articles about that.
But basically, the self-employment tax is calculated as a 15.3% tax on 92.35% of your self-employed income. Now, to be clear, there are some limitations on when this goes. So, I mean, on your first $168,000 basically of self-employment income, you're getting taxed that full amount. And that includes Social Security and Medicare. Now, over $168,600, you're still going to be paying Medicare tax. There's no limit on your self-employment income that they're always going to be charging you Medicare tax.
Mm-hmm.
And then once you get over $200,000 of self-employment income for an individual, or $250,000 for a married filing joint income tax return, you're going to pay the additional Medicare tax of 0.9%. So at the end of the day, there can be a lot of additional tax that you pay as a result of your self-employment income.
Yeah, and it's important that people understand that. And I've worked on returns where I've worked on a Schedule C for a client, and then they get hit with this self-employment tax, and they're like,
"What?
Whoa,
yeah.
This can really," because it's 15.3%, which is a pretty big amount. Especially, obviously the higher number that you go,
right?
The more income you have, the more self-employment tax you have to pay. So it can really blindside people.
It does. Now, it's also important to note that you don't get to take that as a deduction on the business return.
Yeah.
So normally, if you are a company and you're paying employees, and as being an employer, you pay a portion of these employment taxes, the Social Security and Medicare. An employer pays half of those on behalf of their employees, and they get to deduct that portion of taxes on the income tax return for that company. The other piece is getting taken out of the wages of the employee, which the employer is already deducting, so they don't take that other half again in tax expense. Sorry, we're getting into the weeds a little bit, but you don't get to take that deduction for the self-employed income tax, but you do get to take a deduction on the 1040.
Mm-hmm. Yeah, so on your Schedule C, you won't see your self-employment tax deduction.
Yep.
But on the page 1 of the 1040, you'll see it there.
You get to deduct half of it, essentially.
Yeah.
So
you pay the full tax, and it's kind of, we talked a little bit about the difference between credits and deductions.
Yes.
And it's a deduction. It's not a credit, so it's not like a dollar for dollar.
Right.
Lowering your tax liability, that half of your self-employment tax.
Correct. And really, though, if your self-employment is getting up to these levels on a regular basis, it's possibly time to consider, maybe that's a good time to start considering about becoming a different entity type.
Yeah.
And we'll get into that further down the road, but that might be a time you look at, oh, maybe we should be an S Corp, and that maybe that would be more applicable, and that can save you a lot in self-employment taxes, potentially, if it's the right fit.
Mm-hmm.
Going back to my Social Security comment, it's your highest 35 years of income is what goes into your Social Security calculation
Okay.
when you retire.
Yeah, I've
So,
always heard it's kind of like you get paid out what you put in.
Yep.
Pretty much.
There's some calculations that go into it, so you can figure out. There are some Social Security calculators you can find, so you can find out exactly what your payment would be based on different scenarios. So,
Cool.
All right. One other thing, your income on your Schedule C can qualify for the qualified business income deduction, which, in the most simplest of terms, is a 20% deduction on on the income. So if you had net income of $100,000 in your Schedule C, you could potentially get a $20,000 deduction for that. And there are limitations and several things that can actually affect that calculation, but it's one thing to note that applies in this situation.
Yeah, it can get kind of complicated and in the weeds, but at its bare bones, it's just you take 20% of the qualified business income and you use that. Perfect. Yeah, and kind of going on along with that, those deductions that we're talking about, that's if we have income. However, what happens if we have losses, right?
Yeah.
And so since Schedule Cs or sole proprietorships are inherently active, you're actively involved in the business, you're making business decisions, you're keeping track of things, you're actively in the business, we can take those losses against our ordinary income. And so let's say if you have like a W-2 wage of $100,000 and then you have like $30,000 of Schedule C, a Schedule C loss, you can take that $100,000 minus the $30,000 and you're left with $70,000.
Yeah.
Of your adjusted gross income is what it would be. However, let's say you're just a big spender, right? And you have so much business loss, then the IRS kind of steps in and says, whoa, 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 you can't take all of this loss.
Got it.
And what that is called is essentially excess business loss. And how it's calculated is it takes the aggregate deductions of your trade or business. So let's say you have a revenue of 1 million and you have deductions of 1.4 million. So you take your aggregate deductions, so that 1.4 million, and you minus out your aggregate gross income from the business plus a certain threshold amount, a dollar amount that the IRS gives, which is adjusted for inflation. And for 2024, it's $305,000 if you're single, and it's $610,000 if you're married filing jointly. So in this scenario, let's say we have that 1 million of gross income, 1.4 million of deductions. We'll take that 1.4 million, we'll minus 1.3 million, 1,305,000. Let's just say we're filing single, and that's left with 95,000 of your loss turns into excess business loss. Or I guess it doesn't turn into that. That's what it is. It's categorized as excess business loss, and then that in and of itself turns into what's called an NOL, or
net operating loss.
Yeah, a net operating loss, which then gets carried forward to the next year. So for this, if we're doing it for 2024, it would be carried over to 2025. So the total loss is 400,000.
Got it.
Right? But we can only take 305,000 in 2023 to offset your ordinary income, and then that 95,000 that has essentially just been like recategorized as an NOL gets carried forward to the next year, or to whenever you use it, whenever you use that NOL. So yeah, so there you can have loss capture with the Schedule C, and it's something to think about for sure. If you feel like you're going to have a lot of excess, or if you feel like you're going to have a lot of losses. I know, like when you're starting a business, there's a lot of expenses that come into play in the beginning. Just be prepared that if you have too much loss, some of that might get categorized as an NOL.
Yeah. And one nice thing to consider is there's no basis limitation in your loss, right?
Yeah, which comes into play with like a partnership and an S corp.
Exactly. So it can actually be As long as your loss isn't getting super big, if you're not some tech startup, right, where you're going to have maybe millions and millions of dollars of
Yeah.
losses, but for your average small business person, in order to take a loss, Schedule C can be beneficial.
Yeah, yeah, and when I was researching this, I was going on we use different tax research websites, and one of the scenarios that it said is sometimes it might be good to just start as a Schedule C, take the losses in the early years, and then later become like a partnership or an S corp
Or whatever you're going to do.
or whatever, just so that it's just easier to capture those losses in the early years because. And we'll talk about this in other episodes, but just you have, with a partnership or an S corp, you have basis limitations, you have passive activity limitations, and so on and so forth. At risk limitations, and so it can get kind of dicey. But with just a Schedule C, it's pretty. It flows nicely on your return.
Yeah. Okay. Moving on. How do we compensate the owners of this business, Spencer?
A good question. Are the owners of this business employees, or are they like the employers?
Yeah, exactly. So really, owners. So the owner, there can really only be one owner of a sole proprietorship, right? It's in the name.
It's in the
sole,
name.
singular owner. They are not treated as employees. So they should not be paid a salary or get a W-2
Yeah.
or a 1099 or anything that indicates their income from the company.
Yeah.
Right?
Yeah, the IRS, when I was again researching, the IRS essentially just treats a Schedule C as like just you. Like
Yep.
there's no difference between you and a Schedule C.
It's just the money you made in the business is what you get paid.
Yeah.
There's a benefit that you can get by being the owner of a sole proprietorship, and that is you can deduct the cost of your health insurance.
Mm-hmm.
That's actually a really good benefit. If you get a W-2 at your job, but you don't maybe you don't get insurance through your place of work, and you have to pay for your own health insurance, you cannot go and deduct that on your tax return. Well, not 100% of it necessarily.
Yeah, depending on where you get your insurance, I guess.
So if you're a regular person that gets a W-2 and you go and pay for your own insurance, you can maybe deduct it as an itemized deduction on your 1040.
Yeah, depending on how much.
Yep, depending on what your gross income is, essentially. And then even then, you may just be able to get a piece of it or who knows what. But if you own your own business and your family isn't getting insurance through another line of work or something,
Mm-hmm.
you can deduct all of that health insurance on your Schedule C. That's a good benefit. And something that we encourage our clients to take advantage of.
Yeah.
So
Yeah, and when you're thinking about that, it doesn't. So because you don't get a W-2, that doesn't mean that you can't have employees. Like you can have employees of your business.
yes.
And so, you can also, the business can provide health insurance for those employees
Yes.
and such.
Yep, that's true as well. Yep, you can do everything that any other business could do for their employees.
It's just you're treated a little differently.
But yeah, the owner is treated differently. And to go along with that, if you actually are going to have employees, you need to file with the IRS to get an EIN,
Mm-hmm. Yeah,
an employer identification number.
correct. Yeah, acronyms.
Yeah, exactly.
Yeah. To have a Schedule C, you don't necessarily need an EIN.
Correct.
I think we've talked about this before, where you can just start your business and you can just put it on your Schedule C. However, if you start having employees, retirement plans, yada yada, you'll need to have an EIN.
Yep, and that's a fairly
It's
simple process to go through to get one.
yeah, it's not hard.
So, yeah.
Yeah. And kind of going along with that, so if you're not paid or if you're not treated as an employee, how do you get money?
So we went back to you're taxed on the net income of the company, whether or not you have actually taken the cash out of the business to use for yourself personally. That income is being taxed. So then what happens when you do take the cash out?
Yeah, and that can be might be frightful for some, and maybe that's why some people leave so much money in their accounts. But for Schedule C for sole prop, there's no taxable event. And taxable event might sound funny, but it just means that there's no, like, you don't have to report it to the IRS. It's just a withdrawal of cash. Or you can also have non-cash property that you take out of your business.
Sure.
If your business bought a vehicle per se, and it's pretty much run its course on the business, and you distribute it from the business to you, it's a non-taxable event. Similarly, contributions as well is treated the same. Transferring assets, there's no tax consequence, even if the value of the asset has appreciated. So if you have an asset that you bought 5 years ago, and then now it's worth a lot more, and you transfer it to the business, there's not a taxable event that's triggered. You just have a carryover.
Right. You're not going to be able to put it in the business at this new appreciated value.
Yeah.
And then depreciate it. It's just you are putting it in at whatever value it was when you had purchased it.
Yeah, exactly. As well as when you buy assets, the cost of the asset is now your basis in the asset, which is like, basis is kind of an interesting word if you've never heard of it. And if you don't study accounting, I wouldn't expect it because I never heard of it outside of accounting. But essentially, your basis is just like your ownership in that asset.
It's like how much did it cost you to acquire that asset?
Yeah,
is essentially what your basis is.
Yeah, so if you bought a computer for $5,000 or whatever, your basis in the computer is $5,000, and now you take that and you depreciate it over whatever life it is. And so again, so distributions of cash or non-cash. So if you take money out of your business bank account with a Schedule C, there's not a taxable event. Same with contributing money into your Schedule C. There's not a taxable event.
Yeah, it's interesting. So if you're taking money in, if you're putting money in or taking money out of a business bank account, does that even show up anywhere on your Schedule C?
No.
Yeah, it doesn't, right? So
there's not a balance sheet.
There's no balance sheet, right? Yeah. And that's those are balance sheet transactions. On an S corp or a partnership or a C corp, you don't have to report the balance sheet if you're under certain thresholds, but you typically report a balance sheet. And as accountants, we're using the balance sheet regardless of whether or not we're reporting it to the IRS, right? Mm-hmm. You need it. So,
and it's shown on the K-1 as well.
Yep.
Because it goes into, we'll get into this in another episode, but it affects your basis.
Yeah. But on a Schedule C, there's no reporting of a balance sheet. And so that's another way you can kind of think about, money in and out never shows up on a Schedule C directly unless it's an expense or income, right? But if you're personally putting money in or taking money out directly to yourself, that's not going to show up. So one other nice thing about a sole proprietorship are retirement plans. You can set up basically self-employed retirement plans. There are lots of different options. You could set up a simplified employee pension. That's a common one, or a SEP plan, and it can allow you to take a deduction on as much as 25% of your self-employed earnings. Or there are simple IRAs, and there are solo 401ks, and there are...
there's a plethora.
Yeah, there are numerous types of retirement plans. We don't need to go into all the details about them all. Maybe we'll do an episode on it someday.
Yeah, maybe we'll have a retirement plans episode.
But there are a lot of plans you can set up, and you can either include just yourself, or you can include yourself and your employees, and there are rules about how that all works. Mm-hmm. But
yeah, depending upon what plan you get, there's certain rules.
But they're a good benefit, right? That's actually one of the main things we do. If anybody ever comes to us in the last minute and They're like, I'm going to owe a bunch of tax. What can I do? Typically, the one thing that you can always do is it's like, have you maxed out your retirement contributions?
Yeah.
Right?
Yeah.
And it's not quite dollar for dollar. You can't say, I was going to pay $10,000 in tax. Oh, I'll just pay $10,000 to retirement and wipe it out instead. But it doesn't quite work like that. But if you could spend $10,000 in retirement, you might knock off, $3,500 of tax.
Yeah.
And so it's usually going to be more cash out of pocket, but wouldn't you rather pay yourself than pay the IRS?
Yeah. I think of like, especially with like retirement plans being kind of like a go-to last minute tax strategy, if you will. The not so smart idea would be to go out and buy a huge asset just because you want to like lower your tax liability.
Oh yeah.
If you're thinking of, should I, because like for a simple employee pension, a SEP plan, you can contribute as much as 25% up to 66,000.
Right.
And if you're at that level of your income, you can reach up to 66,000. It would probably be in your best interest to put that towards retirement than to buy a $66,000 vehicle, unless you absolutely need it. But
yeah, if you're thinking if you have the cash, and the thing with those deductions, I mean, that has to be cash actually paid, right? It's not just like a book transaction.
Yeah,
right? It's not saying I'm doing this.
Yeah, there's like due dates of when you need to put it in.
So that would be $66,000 cash paid into a retirement plan. Yeah, and if you've got $66,000 of cash that you can just dump after a little bit of tax planning, yeah, it's probably better to put it into retirement.
Yeah.
Than into a brand new truck.
Yeah.
That being said, sometimes it can be worth it to figure out the timing of buying those assets, right? Like if you were a dog grooming business and you needed to buy a new, you were thinking about buying a new van or a new wash tub or something, to get this done, maybe you go to and you're thinking, oh, I'm probably going to do that in February. But then you go to your tax accountant and you say, so I'm thinking about doing this. How much tax am I going to owe this year? Oh, I'm going to owe $10,000. Oh, maybe I'll adjust my timeline and I'll get that in December, place it in service now rather than wait till February. Anyway.
Like tax strategies.
Tax strategy. We are typically conservative, right? As accountants, especially here at Larson, we're conservative. That's what we do. And we're going to be conservative in all ways. We're never going to encourage somebody, say, hey, you need to go buy that new truck. That's never going to be what we're going to say.
Yeah. Going back to like one of our first couple episodes about necessary and ordinary business expenditures.
Yeah, exactly.
We want to make sure we're doing it the right way. But yeah, so that's pretty much all of the things that we wanted to talk about with sole proprietorships. Kind of just to wrap up, you kind of have to think of it like, when would it be good to have a Schedule C? Do you have much of a plan with this business? If not, starting your business as a sole prop just provides the flexibility to just start.
Yes.
And you don't have to. It can be very daunting to try to think about, what should I do? What should I be taxed as?
Yeah, it's almost the default position. I kind of think
it,
of it,
yeah,
right?
Well, it is pretty much.
If you start into a business and like you just start operating and you don't have a partner or something, this is what you are. You're a sole proprietorship.
Yeah.
So it's a very low burden of entry.
Yeah.
And
if you don't decide, the decision's going to be made for you.
That's right.
And so that might be nice.
Yep.
Do you expect to have a lot of loss in the first couple of years? If you do, maybe keeping it a Schedule C for a little bit is your best angle.
Yep.
To take those losses. Do you want to bring other people on? Well, then
you can't do it.
Yeah. Then you might want to think about something else. And are you planning on selling the business? Selling a sole prop is treated as an asset sale, so you'll be subject to multiple types of income when you sell the assets of your sole
Yeah,
proprietorship.
there's no stock or ownership percentage or like anything to consider instead,
Yeah,
right? It can
yeah.
only be the assets.
Yeah. So if you have like inventory or like receivables that you're selling, that's going to be like ordinary income. If you have capital assets, that's going to be capital gain. If you have like fixed assets that you used as part of the business, we're starting to dabble into 1231 gain and loss, and then also like Section 1245 recapture, which is a topic for another podcast or another episode.
Yeah.
But just think of that if you're thinking of selling your sole proprietorship. Um, Obviously, ordinary income rates, if you have a lot of income, is not the best way to, you don't want a lot of ordinary income because the rates can become so high. And that's also kind of thinking of 1231 gain and loss and Section 1245 recapture.
Yeah, you can get into all sorts of things. Like, what if you start this business, you start a dog grooming business, but really you're just going to be the money behind it, right? Maybe you're not actually operating in this entity, and you're going to hire a team of groomers,
Yeah.
right, who go out and do this. Maybe there's an argument to be made that really you're not self-employed, right? So maybe this shouldn't be self-employment income, and maybe it's a more passive investment or something. You know what I mean?
Yeah. Maybe you think of doing a holding company.
Exactly, or doing something different.
Mm-hmm.
So last thing, just make sure if you are starting a sole proprietorship that you're aware of any local or state laws regarding operating a business.
Yeah. There are those.
That's another thing to consider, and that's going to vary by jurisdiction, right? By state, by city, by county, all across the country. There's gonna be different rules.
Mm-hmm. We're looking at things through like the lens of the IRS,
Yep.
right? So when we say, like, for example, the IRS sees your Schedule C, your sole prop, as essentially you. That's going to be different to the eyes of.
That's not taking into account any liability or legal or other issues.
Yeah.
It's just as a tax entity.
Yeah, exactly. Yeah.
And the last thing, and we've talked about it before, and we'll probably always talk about it because it always comes up, but even though this Schedule C is reported on your individual income tax return, don't treat it as just yourself. And what I mean by that is have separate accounting for your business and for your personal life.
Yeah. Yeah, that's very important.
So you need to have separate banking, separate credit cards, separate everything. Don't commingle all of your money in the business and your personal life. And that adds a little bit of, additional work and compliance to do things that way.
Mm-hmm.
But at the end of the day, it's going to be way better for everybody involved. Yourself, your tax preparer, the IRS.
Yeah, if you were to ever get a letter or whatever, you have receipts, if you will. You have things that can back up the legitimacy of your business.
Yep. And I think that's pretty much it.
Yeah, I think we covered a good chunk of pretty much everything about, I think, that everyone should know about sole proprietorships.
If you ever have a question, don't forget to give us an email.
Mm-hmm. We work Monday through Friday, busy seasons, Saturdays, and sometimes Sundays. So we're here.
That's right.
But thank you so much, everyone, for listening, and we appreciate it.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.